Hello, thank you for tuning in today. My name is Zach Backner, and I'm the Director of Financial Planning here at Summit Financial Consulting. Today, we are going to be discussing preparing for retirement, specifically some tax considerations that should be planned for in advance. It can be a very stressful time when you decide if or when you are going to retire. Shifting from a consistent working income to relying on investments, Social Security, other retirement benefits can be very difficult to adjust to. This transition highlights the importance of efficient tax planning. We have seen that many retirees want to pay as little in taxes as possible, since this potentially would require less withdrawals from their retirement savings. This could be an inefficient goal for many retirees. However, we do not believe it is the best strategy in all cases. Of course, everyone has a very unique situation, so it is important to discuss with your tax advisor before implementing any type of retirement withdrawal strategy. One important factor that may vary from case to case is the tax diversification of that case asset. For example, does a client have a lot of savings in pre-tax retirement accounts like an IRA or a 401k? Do they have any after-tax retirement savings like a Roth IRA? Or do they have a majority of their assets in a taxable, non-qualified brokerage account? The tax diversification of a client's asset sheet may impact their tax plan for retirement and the withdrawal strategies that may be most beneficial in their specific situation. One strategy that we see many clients are not aware of when we meet for the first time is the concept of Roth conversions. We did discuss this topic in our blog post on our website at summitfc.net/blog. The strategy involves paying the associated income taxes, then shifting assets from a pre-tax retirement account to an after-tax Roth retirement account. We commonly perform these from a traditional IRA into a Roth IRA. The benefit in doing this is to potentially minimize the overall taxes paid from the client's retirement savings. The conversions are ideal for a case if we can utilize a client's lower tax bracket to prevent required minimum distributions and other withdrawals occurring in a higher tax bracket later in life. It is also important to consider the beneficiaries' tax bracket too, and whether or not they would be paying more to fulfill their inherited IRA RMDs. Instead of kicking the tax can down the road, it could potentially be worth paying the tax now, allowing the money to grow tax-free from this point forward. Having a spouse pass away is often stressful, so next we want to mention a situation that will unfortunately surprise a lot of widows. In our experience, income taxes actually tend to rise after the first spouse passes away. The surviving spouse may be able to file as widow for the first couple of years, but they will eventually revert back to the single filing status. If the surviving spouse lives for another decade, that is a handful of years that they will be using the single tax brackets rather than the previous married filing jointly tax brackets. Also, there will be a reduction in Social Security benefits as one of those income streams will no longer exist. The surviving spouse then has to balance a lower guaranteed income stream with a potentially less favorable tax status. The situation is more of a concern when clients have a larger gap in ages, since potentially one of them will have a longer period of living without the other as a widow. This is just a couple of the main ideas that we discuss with our clients as they are preparing for retirement. Once again, my name is Zach Backner on behalf of Summit Financial Consulting. Thanks again for taking the time to watch this video. If you could, please like and subscribe, and you'll be staying up to date on our next video releases. We'll catch you next time.
Summit Financial.
Working with people you trust.